Hi everyone, welcome to my channel. In today's video, I wanted to share some of my thoughts around these two companies like Tesla and AMD and what traders can learn. So Tesla had their robotaxi event last night and AMD had their advancing AI event last night. Like you can see, it was called as advancing AI, AMD's event, where they were going to make some announcements about their new AI chips, and Tesla was going to announce about their robotaxi event. So in expectations of both these events, the stock price, both Tesla and AMD, were showing some short-term momentum build-up. They were making higher highs and higher lows. But once after the event, both the stocks have faded out and they have returned back. Like the stock prices have retraced back. There were a lot of influencers and there were YouTubers and chatter on Twitter as well about these two events, and then how the stock price can move can explode in the right direction. And I had also made a video on both these events about Tesla as well as AMD, and I had mentioned that it could be a non-event, or the stock, there is a possibility that if the expectations are not as per market expectations, both the stock prices could come back or could retrace or pull back, and that is what is happening. We can see that Tesla's stock price is almost opening in the pre-market, it's almost like 6% down, and AMD fell by almost 3 to 4% last night. So I wanted to share some thoughts about this particular event, like what happened in Tesla and AMD in the last day after the event. So no matter how big the influencer is or how big the analyst is that what they are trying to do is that they are trying to predict the stock price direction, and there is nothing 100% certain in the markets. The stock market can behave, it's an event in future and it's a random event, so the price can move in any direction. So this is one of the most important thing that I wanted to share. Like, there is no crystal ball in the markets. Nobody can predict what will happen in the future 100% accurately. Doesn't matter what their track record is, doesn't matter which bank they represent or which research house they represent. No, it's an event in future, and there is always an element of error in a prediction system. So that is the first important lesson, that if somebody says that this is going to move up or going to go down or it's going to go sideways, it's never 100%. It's never going to be 100% accurate. What the various market participants are trying to do is that they are trying to predict an event in future, and by nature of prediction systems is that they are never 100% accurate. Just like weather prediction is never 100% accurate, all these predictions about the stock price direction, whether it will go up or whether it will go down or whether it will go sideways, is a prediction. What we are trying to do is only we are trying to predict, and the nature of prediction systems is that they are never 100% accurate, and there is always an element of error in the prediction system. So that is the first most important lesson, that there is no crystal ball and there is no 100% certainty in the market that things will go up or down or in the sideways. That is the first most important. So what happens when the prediction goes wrong? So let's take the example of weather prediction. If suppose the weather prediction system says that it's going to be sunny, and if it actually rains the next day, what we do is that we take necessary action, like we take an umbrella or we take a raincoat and we try to protect ourselves. Similarly, in the markets as well, we need to take the necessary action to protect our capital, because capital protection is the number one rule of the game. Without capital, we will not be able to continue to play this game in the markets. Like, we cannot be trading or investing if we run out of capital. So protecting capital is the name of the game, first of all. So whenever the prediction doesn't turn out to be right, we always have to have a stop loss, and we'll have to accept the loss in the first, so that we can avoid a bigger loss in future. So this is the first an important takeaway. Like I said before, like the various chart patterns, the technical indicators, the fundamentals, what the analyst says, analyst views or reports, quarterly reports, quarterly guidance, whom they hire, or the management changes or board changes. All these are like various different factors that are used to predict the stock price direction. So, and the nature of this prediction system is that it cannot be 100% accurate, because it's going to be an event in future. So the stock price could go either in the up direction, or it could move in the downward direction, or it could move in the sideways direction. So we need to be prepared. Our system needs to be prepared for all these three directions in which the stock price moves. So let's, in the next section, we look at what is the difference between a profitable trading system and the mistake that beginners make. So in a profitable trading systems will have few big winners and they will have many small losses. So if you take some of the biggest like professional traders, they have an accuracy of they will have an accuracy of only like 30%, 30 or 40% systems, and the system will be in such a way that it is having a positive expectancy. And when I say positive expectancy, it means that the amount of money that they make from these few big winners compensates for the many small losses, and overall they are able to have a profitable system. So they make so much money from the winners, it compensates, it overrides all these small losses and also returns in excess, so that we can have some profitable system. But when we take the case of beginners, what they do is that they will exit their winners for very small. They will have many small winners, but they will let some of their losses run so big that these losses from these big few big trades overshadows the many small winners, like the profits, and overall the system is a loss making system. So we need to have a system that has few big winners, like disqualify a few big winners and many small losses is very, very important. Now like our brain is hardwired to chase accuracy. We are conditioned to not make any mistakes, and that is the reason why we do not accept these many small losses. We think that if we give it time, or if we give it somewhat we hope that the stock would turn around and will start moving in the right direction, but this rarely happens. And there will be a few trades that it will turn around, and what these trades reinforce in us is it reinforces the bad habit that if we wait for it, all the stocks will turn around and the stock trade will turn into a profitable trade. But these are the worst trades that you can have. Like the trades that turn around and then become profitable reinforce a very bad habit of letting your losses run and maximizing your loss. Always remember that we need to have many small losses. It's okay to accept a loss, and we need to let our winners run. So if we are doing these two things, like if you are chasing few big winners, and if we accept this loss, first loss, that we follow our system of accepting the loss, then we will have a profitable system. If you had learned something new today, and if this kind of changes your perspective on how the market participants profitable traders make money, please do consider subscribing to this channel, and thank you for watching.